If you are 65 or older and you are still paying federal taxes on your Social Security check every single month, I need you to stop right now and watch this entire video. Because there is a very real chance that you do not owe that money anymore. And the IRS is not going to call you. They are not going to send you a letter. They are not going to knock on your door and hand you back what you overpaid. If you do not know about what just changed, that money stays with the government forever. Today I am walking you through the most important tax change for American seniors in a generation. Plain English. Real numbers. No jargon. And exactly what you need to do before April 15th. Here is the headline. Effective for tax years 2025 through 2028, individuals age 65 and older may claim an additional $6,000 deduction. This is in addition to the standard deduction for seniors already available under existing law. It applies per eligible individual, or $12,000 for a married couple if both spouses qualify. It phases out for taxpayers with modified adjusted gross income over $75,000 for single filers and $150,000 for joint filers. Crypto briefing $6,000 per person, $12,000 for a married couple. On top of everything you were already entitled to. And most seniors filing their taxes this year have no idea it exists. Let me show you what the complete deduction stack looks like in 2026. Because 3 separate deductions are now layered on top of each other, and the total number will shock you. The standard deduction available to everyone is $15,750 for single tax filers and $31,500 for married joint filers. For the 2025 tax year, plus an extra standard deduction for seniors of $2,000 for single filers and $1,600 per spouse, or $3,200 total, for married joint filers. Yahoo Finance. And on top of this, qualifying seniors can now deduct an additional $6,000 without itemizing. Married couples filing jointly can each claim it, so it could be $12,000 for a married couple. Lite Finance let me add that up clearly for you. Single senior in 2026, $15,750 standard deduction, plus $2,000 senior addition, plus $6,000 new bonus deduction, equals $23,750 in total deductions. For a married couple where both spouses are 65 or older, $31,500 plus $3,200 plus $12,000 equals $46,700 in total deductions. $46,700 that your income has to exceed before a single dollar becomes taxable for a married senior couple. That is the wall that protects your Social Security from federal tax. And for most seniors, that wall is now high enough that their Social Security benefits are fully protected. Right here, if Lite Finance is giving you the tax information that your accountant should be telling you, but probably has not, hit that like button and subscribe right now. Hit the bell so you never miss a video like this one. Because the strategies coming up next could save you thousands before April 15th. Subscribe now and let us keep going. Now let me show you a real example so you can see exactly how this works. You start with gross income, the total of all taxable income sources. This typically includes work income, most pensions, taxable investment income, and up to 85% of your Social Security income. The taxable share of your Social Security is based on combined income, which equals half of your Social Security benefit plus non-taxable interest plus all other taxable income. Once combined income is greater than $44,000 for married couples filing jointly or greater than $34,000 for single filers, 85% of Social Security benefits are taxable. Crypto news: that formula, written in 1983, was never adjusted for inflation, which is why more and more seniors have been getting pulled into taxable territory every year, even though they live modestly. The new $6,000 deduction is the correction that Congress finally made. It lowers your taxable income enough that for most moderate income seniors, the Social Security tax effectively disappears. Here is the honest truth about who benefits most. The new $6,000 deduction only benefits you if you have remaining taxable income after taking other deductions. If you get your income primarily from Social Security with nothing else, you may already owe zero taxes without the new deduction. The new deduction benefits the middle tier, seniors who have Social Security plus a pension, Social Security plus IRA withdrawals, Social Security plus part-time work income. Yahoo Finance. If that describes you, this deduction is specifically for you. And here are 3 legal strategies to make sure you qualify for the full amount. First, use qualified charitable distributions at age 70 and a half and older. A qualified charitable distribution allows you to donate up to $100,000 per year directly from an IRA. This reduces your adjusted gross income and counts toward required minimum distributions, helping reduce the taxability of Social Security. Second, manage capital gains carefully. Large gains may push you into taxable ranges. Spread gains across years and time major sales carefully. Third, manage part-time work. Because earned income raises adjusted gross income, consider pairing part-time work with Roth withdrawals to keep your modified adjusted gross income below $75,000 for single filers. Crypto news, and here is a bonus strategy that most seniors are completely missing. For the next few years, taxpayers over 65 can convert $12,000 in pre-tax IRA funds into tax-free Roth IRAs at zero tax. If you converted just $12,000 each year, that would create a $48,000 Roth IRA growing completely tax-free. Benzinga, the new deduction creates a temporary window through 2028 to do Roth conversions at effectively zero federal tax. That window closes in 3 years. The seniors who use it will be in a dramatically better position than the ones who do not. Now, one important thing about your state taxes. As of 2026, 9 states still tax Social Security benefits: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. West Virginia completes its full phase-out of Social Security taxation in 2026, meaning all benefits are fully exempt on 2026 returns filed in 2027. Crypto news: the federal deduction does not automatically eliminate state-level taxes. Know your state's rules before assuming your entire Social Security bill is gone. And one more thing worth watching. If Congress passes the "you earned it, you keep it" act, federal taxes on Social Security could end entirely, beginning with 2026 tax returns filed in 2027. As of early 2026, the bill is still pending. Crypto news: this would go even further than the $6,000 deduction and fully eliminate Social Security taxation at the federal level. It has not passed yet, but it is moving. Stay tuned. Here is your complete action checklist before April 15th. When you prepare your return, you will indicate your date of birth. If you are 65 or older, the IRS will automatically calculate your eligibility. A good tax preparation software program should flag your eligibility automatically and apply the deduction for you. If you prepare a paper return, be sure to check the age 65 plus box and include accurate Social Security numbers. COINDC-X. The $6,000 senior deduction created by the One Big Beautiful Bill Act offers a meaningful, though temporary, tax break for Americans aged 65 and older. Though it will not eliminate taxes entirely for everyone, it can help older adults keep more of their income during a time when financial stability matters most. Coin paper April 15th is 26 days away. If you have not filed yet, make sure whoever does your taxes knows about this deduction. If you use tax software, make sure it is fully updated for 2025 tax year rules. And if you already filed without claiming this deduction, talk to a tax professional about filing an amended return to get back what you are owed. Drop a comment below right now and tell me, did you already know about the new $6,000 senior deduction? Or is this the first time you are hearing about it? Because that answer tells me exactly how many people in this community are leaving money on the table right now. And share this video with every senior you know, a parent, a neighbor, a friend, before April 15th. Because this information is time sensitive, and the people who see it in time are the ones who keep more of the money they already earned.